So, Michael Burry, yep, this guy, not this guy, is as infamous as an investor can get. You've no doubt heard the story about how he made billions off of the back of the financial crisis of 2008, how he timed the housing market crash and basically built his own derivative in order to profit off of it. Despite having a fantastic film starring Margot Robbie based on his investing, he's also been busy recently for other reasons. Despite what most people here on YouTube will tell you, Burry is not a one-hit wonder. He timed the dot-com bubble to a T and made himself millions in the process. Then, he went on to beat the S&P 500 every year his hedge fund was active until 2009, when he hit bigger than ever before, made himself billions of dollars and decided to take some time away from managing a fund. Well, since then, he started to run a fund again, and this time, it looks like it's more of the same. He isn't just following the crowd, buying whichever tech stock is hottest right now, although he is long on some big tech names. He's looking for something far bigger than that, and in true Burry fashion, he's kicking up quite a storm in the process. Unfortunately for us, Burry doesn't love attention the way some fund managers do, so we rarely ever get to hear him speak on these types of issues. What we do get are tweet storms once every few months before he quickly deletes his Twitter account again and pretends nothing ever happened. Well, September appeared to be one of those months as he fired up his phone and started tweeting again, this time taking aim at inflation and the Fed, Evergrande, and what we're going to focus on today, the index fund bubble. The idea that there is an index fund bubble isn't actually that new. It's been around for a few years now and it's not too difficult to see why. The S&P 500, the most widely invested in index in the world, has been outgrowing the American economy for some time now. Very simply, this makes a lot of people think that the index is in a bubble. After all, if a company is growing its revenues, profits and customer base by 5% every year, but its share price is growing by 10% every year, it's only a matter of time until it is considered overvalued. Well, the same principle can be applied to the companies that make up a country's stock market and the economy that those companies operate in. There are a bunch of different ways to measure this sort of thing, but the most famous way is something called the Buffett indicator. Now, unsurprisingly enough, it came from the man himself, Warren Buffett, and it involves the aggregate US market value and the US's annualized GDP figures as well. Very simply, you divide the former by the latter and you get an index of how valuable the companies in the economy are compared to the economy itself. Now, if we take a look at how that looks right now, it's easy to see why people like Burry think there's a problem. Historically, the market's value usually sits between 50 and 100% of GDP, but more recently, that hasn't been the case. In the dot-com bubble, one of the largest speculative bubbles in history, where any tech or internet company warranted a ridiculous valuation purely due to the belief that they would change the world, the Buffett indicator sat at about 150%. Right now, the Buffett indicator sits at 239%, its highest ever reading. Now, it is worth pointing out that this measure isn't perfect. In the 50s, for example, when this data started being processed like this, the US stock markets were by and large made up of American companies working in America and generating revenues in America. Today, however, the same cannot be said. The 5 largest companies in the S&P 500, Apple, Microsoft, Amazon, Alphabet, but I'm just going to call it Google, and Facebook, might be American companies, but in reality, they are present in almost every country in the world. Apple generates revenues by selling iPhones and Macs to people in Europe, Asia, Africa, Oceania, and both Americas, not just the US. And the same is obviously true for the other companies I mentioned as well. Basically, the revenues of these companies are worldwide, but the market values are just American. This skews the Buffett indicator to make it seem worse than it is, but unfortunately, even with that taken into account, the US market is still very overvalued compared to historical precedent, and the same can be said for many overseas markets as well. So if there is a bubble in the indexes, why is it there? Well, it's really simple. Index funds are really easy to invest in, so a lot of people do invest in them, and that leads to the values of these companies that make up these indices rising in value. If you go onto a random finance blog or pretty much any investing subreddit, you'll see the usual advice of just put 10% of your paycheck each month into the S&P 500 and you'll be set for retirement. And the truth is, this is actually pretty good advice. It's something I mostly do as well. I love index funds. There's no need to even think about fund managers, sectors or regions. You can just tie your investments to the economy as a whole. The problem is that when too many people do this, when no one invests in individual stocks or actively managed funds anymore, you start to lose the element of price discovery in the markets. You see, when someone who builds their own portfolio decides to invest in a company, they look at its assets, its liabilities, its growth, its revenues, its profits, and then half a hundred other metrics as well. and they decide upon an intrinsic value that the company is worth. If the share price is significantly discounted, then that investor will buy it. If it's overvalued, then they might short it. This is market discovery at work, and it means that companies are valued at what their intrinsic metrics say they should be. But when someone invests via an index fund, they throw money at whatever stock is biggest, pushing its price up further. When everyone invests via an index fund, then the values of the large cap stocks like Amazon, Google, and Facebook continue to get inflated and they don't experience price discovery. Now, this might be a flaw of index funds, but that doesn't mean they're inherently bad. They are hugely useful for ordinary people who don't have the time or knowledge to invest otherwise. And just because they might be the cause of a bubble, that doesn't mean they ought not to exist. So if that's the background on the issue, then what's actually been going on with Burry? Well, first, he tweeted this article. In search of the origins of financial fluctuations, the inelastic markets hypothesis. Now, as far as academic papers go, it's actually not the worst read you're going to find, but it's still far from thrilling. In short though, it proposes that the price elasticity of the aggregate stock market is small, but flows in and out of the stock market have large impacts on prices. Basically, according to this paper, the market as a whole isn't actually driven by demand for stocks, but by the supply of capital within the markets. As for Burry's comments on it all, well, here they are. If $5 incremental market value results from $1 added to stocks and 90% of millennials, aka future wealth owners, are in passive market vehicles, that 5-to-1 ratio will get much sillier in time. COVID didn't stop it, inflation might not. The first step is to recognize that 5-to-1 is not a natural ratio, it is a produce of a paradigm. So what will continue this paradigm? What may reverse it? This is the knife's edge, because we are at 5-to-1, it may go to 100-to-1 or become -5-to-1, but parabolas don't resolve sideways. So what this article said and what Burry focused on is this idea that if someone puts $1 into the market, then the markets as a whole will rise by $5. But if all of that money is injected into passive index funds, as most investments are these days, then that ratio is only going to get higher as price discovery is less and less common. Burry asks the question, if this is a new paradigm, what will change it? And what will continue it? And what the results of this could be? Well, if $1 entering the market causes it to rise by $5, will $1 leaving the market cause it to fall by $5? It's important to note that even Burry doesn't seem to know the full consequences of what this could mean right now, so it's pretty obvious that you and I won't be able to fully grasp it either. Burry suggests that this ratio of 5-to-1 is likely to get much sillier if passive index investing continues to rise in popularity, and that seems like a pretty likely outcome. I personally don't see passive investing falling in popularity considering just how easy it is these days. Maybe if that ratio holds true for the reverse, when $1 leaves a stock, then $5 leaves the market, then when the next crash happens and when the Fed aren't able to drop interest rates any lower or print their way out of a crisis, maybe we will be looking at a far bigger crash than in the past. The easiest way to understand this idea is with leverage or margin calls, and funnily enough, Bitcoin. When Bitcoin falls a bit, some people who have taken out large amounts of leverage see their positions liquidated, sold on the market to pay off their debt, which then forces the price down even lower, which then causes even more positions to be liquidated. If this happens in the US markets, and if the Fed or the Gov aren't in a position to help like they were in 2020, then this could be huge. As for all of this together, I really don't know what the long-term outcome of this will be, and I can't even really tell what Burry's thoughts are either. When we look at everything on its own, it's easy to come to a conclusion. The Buffett indicator is at its highest reading of all time, and the growth in the markets has far outpaced growth in the economy. That's easy enough to get your head around. Passive investing leads to a lack of price discovery and inflated stock prices. That's easy enough to understand as well. Derivatives and leverage mean that when $1 enters the market as a whole rises by $5. Even that is easy enough to understand. But it's not easy to theorize how each of these events will interact with each other. Burry seems to think that this index bubble and the 5-to-1 ratio will work in tandem to create a positive feedback loop that leads to an even more overvalued market. COVID didn't reverse this process, but maybe inflation will. To be perfectly honest, this is really complex, and I'd absolutely love it if Burry came back out and gave us some more insights into his thoughts on the issue. But unfortunately, once again, his Twitter has been deleted, so it looks like we're on our own for now. If you're new to the channel and you enjoyed this video, then make sure to subscribe. If you want to help spread the word, then consider liking the video and leaving a comment, and YouTube will do its part by pushing this video out to more people just like you. I really do appreciate all the support you give the channel, even if it's just leaving a like. If you do want to help out further, then you can check the description for my brand new Patreon, where you can join our private Discord community and get access to exclusive community content that isn't available anywhere else. It's just $1 a month right now, but it's also going to go up in the future, so make sure to join now and try it out before it does. There are also links to my other channels, Stoic Economy and Stoic Crypto, that you can check out as well. Down below, there's a link to my favorite brokerage called eToro, where you can trade stocks and shares, crypto, commodities, foreign currencies, and more, all for 0% commission. And there's also a link down below in the description to BLOCKFI, where you can get up to $250 in free Bitcoin, and you can earn interest on whatever crypto you hold. Whether it's Bitcoin, Ether, or even stable coins, you can earn as much as 14% a year. Thanks for all the support. Thanks for watching. Until next time.